All right, let's take a look at two more questions related to employee liabilities. So in this question, Love to Learn Corporation offers parental benefits to its staff as a top-up on EI benefits so that employees end up receiving 100% of their salary for a maximum of 12 months of parental leave. Drew Lee, who earns $74,000 per year, announced that he will be taking parental leave for a period of 17 weeks starting on December 1st, 2020. Assume that the employee insurance program pays him a maximum of $720 per week for the 17 weeks. Prepare the entries related to its 2020 fiscal year end and ignore any CPP or LEI. So let's just do a quick timeline here just to make sure we know what's going on. So the Drew Lee is going to go on maternity leave starting on December 1st. So the start date for his leave is, let's say, December 1st. He's gonna go on leave for 17 weeks. And the financial statement date is December 31st. So this is our statement date, and currently his leave extends beyond that. So let's think about how we account for employee leaves. So we wait for the triggering event to occur, and the triggering event has occurred here. So Drew Lee has told us that he's going on leave for 17 weeks. So even though his leave extends beyond our financial statement date, we still need to accrue the cost of his leave in our statements. So the first entry that we're going to make is going to need to be debit employee benefit expense, credit parental leave or benefits payable. Now the question is, we need to calculate how much that's going to be because he earns $74,000 per year and he's going for 17 weeks. So how much is that? So let's take 74,000 and let's divide it by 52 weeks because this is his annual salary. So if we divide that by 52 weeks, we are going to get 74,000 divided by 52. So he gets paid $14.23 per week. So $14.23 per week. And then he's going to go for 17 weeks. So times 17. That is going to give us $24,192. So that's the cost to us of his leave, top up that we've agreed to generously give him. So we know that we're going to need to accrue this amount, 24,000, but wait a minute, hang on. That's just how much he would make for 17 weeks, but we're only topping him up. We're not paying him out for his entire 17 weeks. So he's also going to get $720 per week from the government for EI. So 720, sorry, we should have done that over here. So 720 times 17 weeks is going to give him $12,240. So we owe him the difference. So this is what he would have made. This is what he's going to receive from the government, and we're going to top him up to 100%. So the difference then, so the top up is going to be $11,952. So that's the difference. That's the top up. That's the amount we need to recognize as our expense. And so the entry is simply going to be debit employee benefit expense. And I think a payroll expense could also play out here, but a lot of companies use separate accounts just to track benefits, just so that they can see what's going on with each of the different components. And then we're going to have credit, and we're not paying him cash right now. This is because we're accruing this. We're going to pay him over the weeks. So we're going to put benefits payable, right? Because there's no cash changing hands right now. He's just told us that this is what his cost is going to be. So now we've accrued the amount on the books. So is that all that we need to do? Well, let's take a look at the question. So prepare all the entries that they need to make for their 2020 fiscal year. So let's think about this. So what, again, we were at December 1st was when we found out about this. So in theory, that this entry here is a December 1st entry. And we are making entries for December 31st. So we would have had to pay him for 4 weeks. So remembering that this 11,952, we're going to pay it to him over 17 weeks. So how much are we going to pay him per week? So let's say 11,952 divided by 17 weeks. So we're going to pay him $703 and 8 cents per week. So we would have had 4 weeks pass by here. So we would have needed to report that amount. So it would be this amount times 4 is what we would have paid in cash. We would have paid him for the month of December. We would have paid him cash of $2,812. And what's the debit going to be here? Well, we need to reduce this benefits payable amount that we put on our books. So this is going to be debit benefits payable to reduce the liability for the amount that we paid him. And that's what that entry would look like. Okay, let's take a look at one more question before we move on. So in this question, it says, Smiles Inc. pays its officers bonuses based on income. For 2020, the bonuses totaled $350,000 and are paid on February 15th. Prepare Smile Inc.'s December 31st adjusting entry and the February 15th entry. Ignore any CPP or yet. Okay, so now let's do a quick timeline here again. So we've got, it's a 2020, so it's our fiscal year is December 31st, and the bonuses were paid on February 15th. Paid, and this is our FS. What are we going to do? Are we going to accrue the bonus here, or are we going to wait till it's paid out? Well, remember, this is a liability because if it's in the employee's contract that they get this bonus, then it would definitely be a liability, or at minimum, it's a constructive obligation where the employees know. It says that they pay its officers bonuses. So this isn't a thing. So it's either a constructive obligation or a legal obligation. So the bonus was $350,000. What entry are we going to record? We're going to have debit, bonus expense. So it goes to our income statement for $350,000. And we're going to have credit bonus payable. So again, we're going to have a current liability for bonus payable where we're going to remit this amount. We know we will remit it February 15th. So then this is our December 31st entry. So we're accruing the bonus. And then it also asks us for our February 15th entry. And all we're going to do here is pay the bonus. So we're going to need to reverse our bonus payable. So we're going to go debit bonus payable. And credit cash. And again, it's just for this $350,000. So I hope that makes sense. And that is how you account for two very common employee liabilities. So both a parental leave top-up and a bonus payable.